This is Kenny Tan. Welcome to Real Estate License in 14 Weeks. This is episode 41 of Starting from Zero. Today we continue talking about chapter 14. If you like my video, please give me a thumbs up, subscribe to my channel, hit the bell for further notifications, and share this video with your friends. Next, we're going to talk about Income Capitalization Approach. Income Capitalization Approach is a method that is used to establish the present value, which is the present worth of a property based on future benefits. Future benefits refer to future income. And the following are the procedures that are used to establish the capitalization of a particular property, the value of a property. First of all, you have to derive at the gross income of the property. That is the income without any adjustment. And of course, say for example, you have a 10-unit apartment complex. It is very rare that all 10 units are occupied. So sometimes you may have a vacancy that you need to subtract from the gross income. So if you have a 10 units apartment, each unit is being rented at $900 per month. So each month you're getting about $9,000 in gross income. Times 12, that's about $108,000 a year. But if you have a 10% vacancy, from the $108,000, you have to subtract $10,800. After you account for vacancy, you have to figure out what are the fixed expenses and variable expenses. Now, the fixed expenses would include things like taxes and insurance. Typically in a year, the property taxes are fixed, even though each year it goes up by a certain percentage, but we still consider taxes as fixed expenses. Same thing with insurance. Throughout the year, the insurance is a one-time payment thing, so it's a fixed expense. However, certain expenses are variable from month to month. For example, the management fee, utilities, and maintenance. Those are variable expenses. So you figure out the annual number for the fixed expense. So if a monthly expense for the taxes is a certain dollar amount, you have to multiply by 12 to give you the annual fixed expense for taxes. Same thing with insurance, and same thing with the management fee, the utilities, and the maintenance. Everything is annualized. So you take the gross income, subtract the vacancy rate, and then subtract the fixed expenses, and then subtract the variable expenses. After you've done all of that, you will arrive at a number, and that number is called the net operating income. In the book, there is an example that shows you step by step how you can arrive at the net operating income. You do it by doing the math that I just mentioned earlier. Actually, there's another expense that I forgot to mention, which is the replacement allowance. Replacement allowance refers to things like roof and carpet and painting that you don't do it annually. You do it like every certain number of years. For example, you might change the carpet every 5 years. You might replace the roof every 20 years. And you might repaint the property every so many number of years. To give you an example, let's say it will cost $50,000 to replace the roof, and it's divided over 20 years. So each year, the replacement allowance, the replacement reserve for the roof is $50,000 over 20 years. So the formula is gross income minus vacancy rate minus fixed expense minus variable expense, and minus replacement allowance. So you arrive at the net operating income. Now, speaking of income, there are three important types of income, the three definitions of income that might be tested in the DIE exam. The first category of income is called the contract rent. Contract rent refers to how much a tenant is paying on the rent according to the terms of the lease. If each month the lease calls for $1,000 of rent payment, so the contract rent is $1,000. But contract rent does not equal to market rent. So what do you call market rent? Market rent, you call market rent by economic rent. Economic rent means market rent. The next definitions are quantity, quality, and durability. Quantity of the rent refers to the amount of the rent. Quality of the rent refers to credit rating of the tenant. And durability refers to the duration of the lease, whether it's 1 year, 2 years, 3 years, 4, even 10 years. Capitalization rate is the investor's total expected return, which includes the return on capital, that means profit, and the return of capital, that means recovery of the capital through depreciation allowance. Now what that means is, let me explain to you what depreciation allowance means. The tax law allows a landlord, a property owner, to take a certain depreciation allowance each year as a tax benefit. The capitalization rate is actually influenced by risk. The higher the risk, the higher the capitalization rate. Take the Bay Area, for example. If you invest in Oakland, the overall cap rate in Oakland might be about 8%. And the overall cap rate in Burlingame might be around 2%. And why? Investors consider Oakland to be of higher risk, perhaps due to the environment, higher crime rate, and things like that. So it's more risky to invest in Oakland. Therefore, the capitalization rate in Oakland is actually higher. Now, in the case of Burlingame has a safer neighborhood, a nicer neighborhood, and it's considered to be a lower risk. Therefore, investors are willing to pay higher price. As investors pay a higher price on the investment, the capitalization rate goes down. So the investor is willing to accept a smaller return in exchange for stability of the investment. Whereas in Oakland, an investor is willing to take the risk and in exchange get a higher capitalization rate. The income capitalization approach is also known as the property residual process. The two names are interchangeable. Remember in my previous videos, I mentioned to y'all that oftentimes at the DRE exam, they like to test you on your knowledge of names that are interchangeable. Income capitalization is exchangeable with property residual process. So in other words, property residual process is just another name for the income capitalization approach. Now, if you use the property residual process to figure out the value of a property, if you're trying to evaluate a property using the capitalization rate, the formula is as follows. Value is equal to the net operating income divided by the overall capitalization rate. Now, the reason why there is a word overall in front of capitalization rate is because you will take the overall capitalization rate for a certain neighborhood. For example, a capitalization rate, a cap rate for a particular property in Oakland might be 7.9, another one might be 8.4, another one might be 8.0. So you take the average, you take the overall. And then for a particular property that an investor is thinking about buying in Oakland, he will take the net operating income divided by the overall cap rate in the neighborhood. Now, let's say if he takes the net operating income for a particular building and divided by the cap rate and arrive at the value. Now, if the value of the property is lower than the listing price of the property, that means that to the investor, this is an overpriced listing. Whereas if the value of the property is higher than the listing price, that means that he's getting a good deal. Next, let's talk about cash flow. What is the definition of cash flow? Cash flow refers to the difference between the income versus the loan payment. If the loan payment is higher than the income, that means that the investor would have to pump in money onto the property every month. But if the income is greater than the loan payment, then there is positive cash flow. That means that every month investor can keep some money in his pocket. So that is the definition of cash flow, the difference between the income and the loan payment. This is the end of episode 41 of Starting from Zero. See you next time.